What's up, guys? Your boy Quick Stocks is back. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your analysis of Baidu, ticker symbol BIDU, trading for $100 a share as of May 9th, 2020, equating to a market cap of $34.5 billion and a crazy PE or price per earnings ratio of 104. With earnings in 2 weeks, is it time for us to finish off the Chinese trifecta? Or should we say bye-bye Baidu? This is your quick stock analysis. In case you weren't aware, Baidu is a multinational technology company that is one of the largest AI and internet companies in the world, with a whopping 64% of China's total online search market, which equates to 78% of China's mobile search and 43% of China's desktop search market. Baidu also benefits from the fact that it operates in a country of almost 1.4 billion people with an expanding middle class. Considering 90% of internet users in China use Baidu, from the outside this looks extremely promising. But pump the brakes, boys, we ain't done yet. Of course, as any good tech company, Baidu also has numerous spin-off products, including Baidu Maps, Baidu Cloud, which is the only Chinese internet company listed among the top 30 AI patent applicants worldwide. Baidu Wallet, which of course is a payment platform. Baidu App Store, known as Baidu Mobile Assistant, with over 200 million daily active app users. Let's knock it out of the way quick. The reason Baidu's PE or price per earnings ratio is so high is because in the last few quarters, Baidu has been reinvesting large amounts of money into its company iQ. And for simplicity's sake, you can think of iQ as the Chinese version of Netflix. Just to put this into perspective, iQ contributes to 9% of Baidu's total revenue. However, iQ accounts for 40% of Baidu's cost. Historically, Baidu's PE floats around 25. Anyway, we are getting ahead of ourselves. Back to reality. Oh, there goes gravity. Baidu's book ratio is bonkers in actuality. The company's assets minus liability is only 1.4, implying some kind of alchemy or fallacy. Regardless of the nationality, for a tech company, that's financial insanity. In case you aren't picking up my analogy, what I'm trying to say is, this is bonkers, boys. Baidu's book ratio, which of course is a company's total assets minus total liabilities, was only 1.4 at the end of 2019. Typically, investors consider stocks with a price-to-book ratio of under 3 to be a value investment, let alone for a tech company. However, the price-to-book ratio should not be used as a single evaluation of a stock, because while a low price-to-book may mean an undervalued company, it can also be as a result of serious underlying problems within the company, which one could make a fair argument towards the latter of the two. Let's be real, with Baidu investing so much of its free cash flow into iQ, one could argue they will not have the resources to keep up with their competitors in other major markets, like AI and cloud. In China alone, Alibaba and Tencent are absolutely crushing it, and significantly larger. Let alone if other competitors start entering or re-entering the Chinese market, such as Google, who is yet another quick stocks company choice. But I kinda doubt that will happen. With rising tensions between the US and China, I doubt that the CCP is going to let a foreign company enter, let alone become the dominant search engine in China. However, this could compromise Baidu's ability to expand outside of China, specifically its search engine. While talking about the CCP, I gotta note, Baidu is a variable interest company, or a VIE. Don't tune out yet. This is important. A VIE is used to establish ownership of a company through legal agreements as opposed to direct share ownership. So when you buy shares of Baidu, or Alibaba, or Tencent for that matter, you aren't actually buying shares of Baidu. You're buying shares of a VIE based in the Cayman Islands, who have an agreement with the company you would like to invest in. But let's say the government of China bans VIEs. You could potentially lose everything. And you may be asking yourself, well, why would the Chinese government want to do that? Well, technically it's illegal for tech companies in China to sell their shares to the American public, and this is a workaround of sorts. However, if China were to do this, in my opinion, it would be as a result of much larger tensions, in which I don't believe share prices will be our biggest concern. However, it's important to acknowledge this fact when investing in Chinese companies. But this isn't the only problem facing Baidu. Multiple lawsuits are being filed against Baidu and IQ, accused of fraud and inflating its financial numbers. I don't have enough knowledge to make an educated opinion, but you can take it for what it is. With all of this in mind, considering Baidu is a VIE, China and US tensions seem to be building up rather than de-escalating, it's hard to tell the accuracy in their reporting numbers with multiple lawsuits regarding the topic. And considering we already have a position in Tencent and Alibaba, which honestly, as an investor looking for a play into the Chinese market, seems like a much better option. For us, here at Quick Stocks, we will not be finishing off the Chinese trifecta. I'm not arguing at its current valuation, Baidu is rather intriguing and has plenty of growth opportunity ahead of it, just in its search engine alone, let alone streaming, AI, voice, autopilot, and cloud. And with all this in mind, one could expect significant increase in share price. But there's a lot of risk for me that doesn't outweigh the upside, especially considering there's plenty of great companies that don't require the same risk tolerance. Anyways, guys, this was your entertainer, I mean reporter Quick Stocks. As always, the best investment you can make is to go long on Quick Stocks. Subscribe now at 120 subscribers and plan an early retirement. I'll catch you guys in the next one.